Welcome to the channel. I'm Jay Fielder, retail investor, macro strategist. Today, we're going to discuss 6 reasons why the stock market and the crypto market has bottomed and why there's a lot more upside than downside. Now, whether we move sideways, up or down, that all depends on the macro environment. And that's what we're going to talk about is the biggest risk in the market. Right now, the biggest risks in the market are resurging inflation, the trend starts moving back up, or stickier inflation. So inflation sticks around a little longer than expected, or complete collapsing growth. So the first reason the bottom is in is inflation is trending lower, right? If we look at CPI, we look at PPI, or the Fed's preferred inflation indicator, PCE, they're all trending lower year over year. If we look at energy prices, oil and natural gas have come down a lot. Natural gas is down near 80% and oil is down 50%. Although we got that cut in production from OPEC, it kind of spiked oil prices, but unless we get above 83.5, I don't think it's really a concern because demand is still falling in the US due to the credit crunch and the lag effects. So goods inflation is falling. Now on the services side, it's a little more stickier. Shelter is really the issue. When we look at shelter costs, they're still on the rise, but they are lagging. So they're on a lag effect. If we look at the housing market, a lot of the shelter rents are on a contractual basis, which means eventually those contracts are going to reprice to match the weakness in the housing market. Next, we have labor costs, and labor costs are slowly coming down. If we look at wage growth, they are elevated, but wage growth is falling, right? Average hourly earnings are kind of neutral, but labor costs are not moving higher. Now, look at the ISA manufacturing and the services, and we see prices paid are also coming down. We see employment coming down. We see durable good orders also coming down. And in some cases, we have inventories rising, especially in services, which usually leads to prices coming down. So that's what the market wants to see, inflation trending lower. And as the data comes in lower each month, it pretty much turns into a tailwind for risk assets. Okay, so inflation trending lower brings us to our next reason why the bottom is in for markets, which is the end of the rate hiking cycle. And to understand this, we really got to go back to 2021 when markets were moving higher and Fed Chairman Powell basically said that he was not thinking about raising rates. He wasn't even thinking about it. But as soon as it came around in November, he gave the expectation that they would be hiking rates, and they wouldn't be hiking till 4 months later in March, but he gave the expectation, and we saw riskier assets like NASDAQ and crypto start selling off first and lead the rally to the downside. In reverse, now we're at a point where the Fed is starting to break things in the economy. We saw the banking crisis start to take place, right? There's a commercial real estate crisis at hand right now. And you look at all these regional banks and we see flight deposits, people running into money market funds. So with this potential banking crisis and the credit crunch, we're basically seeing the Fed start to reverse now. We see liquidity start to come back into the system. It took them a whole year to pull $1 trillion off of the Fed's balance sheet. And now they added back 430 billion just like that. Now they shaved some off, but what it tells you is there's a lag effect with rate hikes. We're starting to see that effect take place, which tells us the Fed is pretty much done. They can't really tighten much more without breaking things. And if they break stuff, they're going to have to inject more liquidity back into the market. And that's what the market is looking at. If we also look at other central banks, we look at the Bank of Canada, we look at the Bank of Australia, and they led the rate hiking cycle to the upside back in 2022. They are now leading the pause, the end of the rate hiking cycle for central banks in general. So you're basically starting to get things break in the economy, which causes the Fed to be in a tricky position where they can't really hike much more, maybe a little bit more. But either way, as long as inflation is trending lower, the markets are pricing in the end of the rate hiking cycle, and that becomes a tailwind, just like it did a headwind in 2021 in November. It's becoming a tailwind to risk assets, to stocks and crypto. And that sort of leads us into this idea of a Fed backstop. I think the Fed, the US Treasury, the FDIC are all committed to making sure there's no more banking problems. Therefore, they pump more liquidity into the system. That money doesn't go into the economy because credit is contracting. We know that, but that liquidity finds its way back into the market. So this Fed government backstop keeps growth from absolutely collapsing. When we look at the growth numbers, labor force participation is still pretty strong. We also see spending starting to come down with the consumer savings rate actually picking up. And that tells me that the consumer is preparing themselves for recession, which is good. Unemployment is still surprisingly lower than expected. Payrolls, they're still coming out higher than expected, although they're still trending down. So it's not too inflationary. Average hourly earnings are staying steady. So growth is slowing, but it's not collapsing. That's exactly what the market wants to see as a tailwind. So we don't want to see data come in that's super higher than expected or much lower than expected, but right in the middle, maybe barely beating or right under. As long as we get that, I think that's an even balance for the market to see that as a tailwind that, okay, the Fed's going to backstop the system. But at the same time, inflation is trending lower and growth is slowly starting to trickle down. Okay, so with the Fed backstop, slower growth, no collapse, brings us to the next reason why the bottom is in for markets, and that is liquidity. If we look at M2 money growth, we see we're at the cycle lows turning up, and that's really being led by the Bank of Japan and the Bank of China stimulating, pushing liquidity into their market, into their economy. That liquidity injection becomes a tailwind for markets to move higher or sideways and at least not make any new lows. So the fifth reason the bottom is in is pretty simple. The bear case is inflation will remain sticky. The Fed will keep hiking rates. Earnings are going to fall much further than we thought. So a lot of fears in the market. And at the same time, you have a banking crisis, and all that sentiment leads to people piling into cash, being overweight cash, underweight risk assets, underweight stocks. So you have this structural positioning dynamic where there's less selling pressure in the market because people are waiting for that big drop to happen at some point. When you have less sellers and people waiting, that's going to be a bid on the market, especially if liquidity is coming in. And at the same time, every single month, you have 70 some million, millennials, 401k still buying into the market. So there's still going to be buying pressure no matter what, month after month, while a lot of cash is on the side. So any little bit of good news is going to cause people to try to, kind of FOMO in. Or if we do get any kind of big drop, investors might be a little pressured to buy the dips and scale in a little bit at a time. And so I think that's another reason, positioning too much people in cash. You got a record 5.2 or 5.3 trillion dollars in money market funds, returning 5% on your money, but a 5% move in the stock market from these lows has a lot more upside than 5%. Now, my last and final reason for the bottom being in for stocks and crypto is about the technical dynamics taking place in the market. So first, I want to start with bond yield. And what we see is that bond yields are coming down. Bond yields look at growth and inflation, and they're pricing in lower growth, lower inflation. Lower yields means lower borrowing costs. That's another reason why markets are going higher. As long as those yields continue to fall, now I know it's like, okay, well, if yields fall, then growth is collapsing. But we already talked about the liquidity coming into the market, and the market can overlook lower earnings because it's anticipating the end of the rate hiking cycle. It's anticipating liquidity coming back in 2024 into the future. Also, looking at the dollar, the reason the dollar has went up so much, and the dollar is the wrecking ball, the more the dollar goes up, the more asset prices come down. So what we see, and that's not always the case, but it's been the case in this environment. So as yields come down, as rates come down, we're seeing the dollar also come down. The dollar is at support. And if the dollar breaks that support, then I think we're going to roll over, and that's just going to be another tailwind for markets. So lower yields, a lower dollar becomes a tailwind for markets. And what that also means is a lot of people are pricing in earnings really low, but if yields come down, again, investors are going to say, okay, well, borrowing costs are lower. As the dollar comes down, that's a deflationary force or a disinflationary force that can actually be a boost for earnings to some degree. And I'm not saying earnings go up or anything, but I think they're going to be, better than feared. We look at margins and, valuations become a little better because yields are down. With the recession or with the credit crunch, we've seen a lot of tech, and I think this is why tech is leading, do a lot of cost cutting. So the more cost cutting that we see and that we have seen, that's going to also improve margins to some degree. They're not skyrocketing, but they will be, in my opinion, better than feared. The last thing I want to say is volatility. We look at NASDAQ volatility, we look at the S&P volatility, right? And the trend of volatility for at least the S&P 500 is starting to roll over. It's starting to break. And every single time that we saw volatility basically break the uptrend and start rolling over, it was the beginning of a new bull market, or the bottom was marked in. Now that the banking crisis started, we have that Fed backstop. We know liquidity is going to come in. We know we're at the bottom of the M2 money supply cycle. Of course, this all depends on, does inflation resurge? Does inflation stay stickier than expected? And does growth completely collapse? So my thesis is, the Fed will backstop the system. Inflation's trending lower. The market is looking at the end of the rate hiking cycle. Stocks and crypto, especially bonds, are all breaking technical resistance. They're all breaking the bear market trend. They are above these daily moving averages. Now they're starting to move above weekly moving averages. And unless the environment changes, the bottom is in for the market.